series of Oxford Economics podcast interviews. I'm Gabriel Stein, Director Asset Management Services, and I'm sitting here with Adam Slater, lead economist, and we're going to be talking about the Oxford Economics top 10 predictions for 2016. Adam, you have just put out a research briefing for our clients, which looks at the top 10 predictions. Do you want to quickly summarize how we see the world in 2016 before I start throwing questions at you?
Sure, okay, Gabriel. As you say, we've put a research briefing out about this, and the top 10 starts with an overall view on world growth, which is that it'll be relatively steady next year, but still rather sluggish. So not picking up much at all from the pace we saw this year, about 2.5% again, which is also below the long-term average the last 30 years or so. So essentially this subpar growth phase that we've been in since 2011 is going to continue for another year. Now, partly in consequence of that, one of our other big calls for next year is that there's going to be a rather slow pace of monetary tightening in the US. Very topical, of course, after yesterday's first interest rate rise.
Indeed, and we'll get back to that later, so we'll talk more about that, but to continue.
Okay, and we're also looking at a world where much the same divide will exist in growth terms as it did this year between the advanced economies and the emerging markets. So actually we think G7 growth is going to improve next year to 2.1%, which will be the best performance since 2010. But in the emerging markets, we are still seeing a relatively weak overall picture, only a small improvement from this year's performance. Further controlled slowdown in China, and particularly problems in the commodity exporting emergers. We don't expect any big improvement in commodity prices next year, and as a result of that, we're looking for a relatively weak performance by that group of emerging markets, and so that'll be a drag on world growth.
Now, talking about that, the commodity performance, but you're also talking about slightly improved G7 growth and maybe a little bit of pickup in the emergers, not very much. And when we talk about commodities, we tend to think of things like oil, which is of course very much in the news with the oil price plummeting again. And then if we think further than that, we tend to think of other hard commodities like perhaps iron and copper and spare a thought for gold perhaps. But more rarely do we think about soft commodities, agricultural commodities. And if there is some improvement in the world economy, wouldn't there be a reason to expect perhaps a little bit of a pickup in the soft commodities segment? In other words, people will spend more on food, or is that simply so inelastic that it doesn't matter? Demand is so inelastic that it doesn't matter?
Well, you have to treat each commodity separately. I mean, in the last year or so, for example, soybeans have not performed very well. They've been weaker alongside some of the hard commodities you already mentioned. And that may well be due to the sensitivity that they have to activity in China, for example. With other soft commodities, there are all kinds of supply factors that can interpose themselves in the story as well, wheat and cocoa and things like that. And there's always scope for some of them to outperform the herd, as it were. But overall, it still looks like a pretty negative picture. And as I said at the start, the growth pickup we see next year is really very, very minimal. In fact, there's quite a good danger that growth could end up next year being more or less the same as this year, even lower, if a few downside risks crystallise that we outline also in the RB.
Well, let me move back to the Fed and talk a little bit about that. So our forecast is that the Fed will raise interest rates twice in 2016, or perhaps we should say the Fed will raise interest rates by 50 basis points, because there is possibly an argument that instead of using the quarter point moves that we have become used to globally, they might move in smaller steps, but 50 basis points. Now, if we listen to what Janet Yellen said at the Fed press conference following the decision to raise rates on 16th December, She talked about the Fed funds rate being approximately 1.5% at the end of 2016, in a year from now, and that would therefore mean 100 basis points for 25-point hikes if we want. Why do we have? Why is our view so much more dovish?
I think that's a very good point you've made, and it's not just our view which is more dovish than the baseline view the Fed outlined. Market expectations are also for much more restrained pace of rate increases next year.
So the question should be, why is the Fed so much more hawkish?
I think that is probably right, yes. I think there is still quite a widespread view that the Fed will be very cautious in the face of a number of factors. First of all, that the US economic recovery is still not that impressive in terms of overall growth rates. We've still got growth around about 2.5%. Wouldn't take much in terms of extra shocks to push it back towards 2 again. That sort of thing. There are also concerns about the financial side, about what even modest rate increases might do to riskier assets, including stocks, which of course have already had a pretty choppy end to this year.
But they did rise following the hike.
They did, yeah. So far, so good, fingers crossed. But I think these concerns are still very much out there. There's still at one end of the spectrum of opinion, if you like. There's still a view that the Fed might be going too soon, and they might have to even reverse their position at some point in the next 12-18 months. It's not our view, of course, but it's a view that's out there, and that all feeds into market pricing. So I think this is what it is. I think there's still a lot of nervousness about how resilient the US economy and financial markets will be in the face of this change of regime after such a long period of zero interest rates. Now, of course, it may well be that the Fed predictions prove to be correct and the market is wrong. But you can. I think it's easy to see why there is that degree of caution. And I think another point for us is that we are on the more dovish side in terms of the world growth outlook as well. And we are certainly of the view that this year US growth has been held back by the global backdrop, weak exports, weak demand in emerging markets, and we don't see that improving an awful lot next year. So I guess from that perspective too, there's a case to be made that the Fed could be more cautious, especially with another year of dollar strength, which is one of the top 10 forecasts.
And yet, looking back at previous tightening cycles, in retrospect, we usually find that the Fed raised rates faster than the markets thought and faster than the Fed thought.
Yep. But we cannot always assume that the past is a good guide to the future. This is an unusual tightening cycle, I think, by any standards.
That's perfectly true. Let's move and talk about another area of concern, which we certainly encounter a lot of when we meet clients and prospects, which is China. So we're talking slower growth in China, but no hard landing. We used to be somewhat more pessimistic about China. Is it really what we're seeing? Is this the case that the multifaceted and almost frenetic monetary and fiscal stimulus that we have seen since really November 2014 is now feeding through and improving the outlook slightly? Perhaps not better than this year, but better relative to what we thought might be the case.
I think there's certainly got to be some positive impulse from the policy loosening we've seen, yes. And also with the gentle depreciation of the exchange rate now coming into play as well.
Which is likely to be intensified since they all of a sudden decided
the
RMB will be measured against the basket.
Indeed, and that's to some extent in our forecast, because we have the RMB going further against the dollar to about 6.6 the first half of next year. So we do see some more nominal depreciation there against the dollar at least. So the policy loosening, yes, is definitely having an effect. I think we've never really said here that we thought it was going to be a hard landing or anything like it. I think what we have said in the past is that there was obviously quite a big slowdown in the last year, and that was having very strong impacts on neighbouring countries, the rest of the world. I still think we take the view that the process is reasonably controlled and that it will continue to be so, and obviously the policy loosening helps to ensure that.
One last question on this part of our forecast. One of our calls is it's going to be a bad year for US equities. For which equities is next year going to be a good year?
We are more upbeat for the Eurozone and for Japan, where with the Eurozone I think we now have equities rising by around 10% by the end of next year, and Japan about 8%. In the case of Japan, that will be a somewhat less torrid pace of increase than this year, but still quite respectable. So those are the two areas where we're a bit more positive, whereas with the US we're looking for not insubstantial correction in the first half of next year, around about 6%, before flattening out, slightly improving towards the end of next year.
So not a buying opportunity?
I think based on our forecast it wouldn't be a buying opportunity for the US right now.
Okay. Now, you also mention that there are a number of wild cards. There's 6 wild cards. Let me just run through them very quickly. That's oil at $20 a barrel, deeper journey into negative interest rates, credit cycle turns more decisively downwards, a surge in emerging market corporate defaults, Fed policy error, and Brexit. Now, of these, I'm going to ask you to pick 2. One which you think of these, and they're all wild cards, so they're all unlikely. But which of these unlikely ones is, in your view, the most likely? That's question 1. And question 2, you only get to pick one. Which would be the most harmful, the one that would really throw the world economy?
Which is the most likely? I would say probably it is the credit cycle turning more decisively, because we already have some elements of that in play, and I think there are a variety of reasons for thinking that things could deteriorate in that area next year. The only real question is the extent. The wild card we have here is for something quite decisive as a turn, rather than a moderate correction, if you like.
Indeed, that's very clear. These are all unlikelies.
So that I would say would probably be the most likely. Which would be the most damaging? I would have thought probably Fed policy error would have to be the most damaging if the Fed was forced to reverse course some point during next year, having got it badly wrong, having raised rates too quickly, and having provoked a really nasty reaction both in financial markets and the real economy. I think I'd have to put that one at number 1 in terms of the most damaging.
But equally, I suppose, since we think the Fed is going to act very cautiously, we think that's highly unlikely.
Yeah, that's why it's in the wildcard list, I guess. Yeah.
So perhaps a positive note to end on. These were all wildcards. Thank you very much, Adam. Thank you, everyone, for listening. We will, of course, be back with further podcasts in the future on a variety of topics.